Details from Apple's call. Let's get back to Julia Boorstin. Julia.
Yes, I'm just listening to the Apple earnings call right now. We're getting some more commentary on Tim Cook and Apple CFO on guidance. They say they expect solid year-over-year revenue growth despite significant supply constraints, which we estimate to be less than what we experienced during the December quarter. But we expect our revenue growth rate to decelerate from the December quarter, primarily due to two factors. During the March quarter a year ago, we grew by 54%. And they say, remember, we launched our new iPhones during the December quarter, while this year we launched them during the September quarter. They also, he did say they do feel good about the momentum of the iPhone, but they did note they expect foreign exchange to have a negative impact on growth. And services, they expect to grow strong double digits, but do expect that services growth to be decelerating from December performance. And that, of course, is because a higher level of lockdowns led to increased usage of those services. Melissa, we do see the stock now of about 3%. I'm going to continue to listen to Tim Cook on the call. Back over to you.
So just to get this straight, Julia, this is a deceleration quarter on quarter, correct? From the March quarter, from the December quarter. Okay. Got it. Keep us posted, Julia. Thank you, Julia Boorstin. Tim Cook was talking about a couple of sort of technical issues in terms of when they launched things as one reason, but there's also a seasonal aspect to this, I would imagine, Karen. Typically, first quarter is not, calendar year first quarter is not a strong one compared to calendar year fourth quarter.
Right. Also, I mean, this quarter ended December 25th. That does leave one or two pretty good weeks of after Christmas to be in this current quarter. But I don't think, like you're saying, I don't think this changes the story at all.
Yeah, okay. The stock is still up by about 3%. We'll keep you posted on this call if anything else comes out. Tech pulling back again today, as you know, and if you caught the show a few weeks ago, you heard this.
When you look at where this can rally to, 390 is a big level. I would be a little careful here. I would be more prudent. I'd be taking some off the table as triple Qs rallied into that big level around 390 because the internal complexion of this market is just not as technically sound anymore.
That was Fast Money friend Chris Verrone raising the red flag on the tech trade just over 2 weeks ago. The QQQ ETF dropping more than 11% in that time frame. And now he has got a new call on the market, as well as some opportunity plays. So let's go off the charts with Chris, who joins us from Strategas, a Baird company. Chris, what are you watching?
Hey, Melissa. Yeah, listen, I think we just have to put in context, what we've seen, not just over the last 2 or 3 weeks, but remember the triple Qs peaked on November 22nd. High to low, we've had about an 18% drawdown. That's a big move. We've taken the S&P down about 12. So when we look for good oversold conditions or tactical lows, we're really on guard for two things to develop. So if you bring up our first chart here, we're showing you put-call ratios. We look for stress in sentiment. And we've seen that develop here over the last several days. We've had now 3 sessions where put-call ratios have been in at least the 95th percentile of the historical data set. So we have some stress in options. We also look for stress in price. Our next slide here is just showing the percent of S&P stocks making a new 1-month low. When you start getting 60, 70, 80% of the S&P making a 1-month low on the same day, right? That's that flush internally that tends to present itself at or near some type of a tactical bottom. So we have stress in options, and we have stress in sentiment. And then I think really importantly here, note how the character of this correction has simply been different than anything we've seen over the last 12, 13 years, right? This is the first 10% correction where bond yields have actually gone up, not down. That is a meaningful shift. And where I think that's manifesting itself is through leadership. I thought Dan said something so important earlier. He said, in markets like this, focus on where the emerging relative leadership is. Well, we brought along 2 names to try and do just that. One in the machinery group. Parker Hannifin has quietly been improving throughout this entire corrective phase. We just made 6-month relative highs. Parker Hannifin has not broken below its December lows. Machinery, I think China easing there probably helps as well. Those names, that whole group really turning up. And then second, look at some of these insurance stocks. Here's Aflac coming out of a big base. Another name that you wouldn't really expect to be a leader in a correction has started to show some really great relative strength. There's great support, 58 to 60. I'd be a buyer of any weakness there. Insurance is leadership globally. Get some exposure domestically.
All right, Chris, always great to see you. Thank you. Chris
You too.
Verrone
Thank you.
of Strategas, a Baird company. Guy Adami, I don't know why you're chuckling, if you're thinking about the duck as it relates to Aflac, or I don't know what crosses through that mind of yours.
It's hard to tell sometimes, but you know, Chris mentioned internal flush, and you know, I was saying to myself, I'm very familiar with that, unfortunately, but I don't want to get into that on this Thursday, because why should we? What I will say, though, Mel, because I know you pay attention, it's the cheapest thing you can do. We've been saying for a while that if rates are going to go higher, the insurers will go higher. And oh, by the way, Jefferies initiated a bunch of insurers yesterday, Aflac being one of them, I think was a neutral, but MetLife, a name we've talked about for a while, I think they have a 13% more upside in that name, and that's a stock that continues to make new all-time highs. So if you think rates are going higher, like I do, I think you stay with the insurers. Well done, Chris Verrone.
Would you take BK, either Aflac or PH?
Ooh, would you rather? So I would pick Aflac, and for exactly the reasons that Guy mentioned. You think about what their business is. They're betting that you're not going to get hurt, and they're taking your money and investing it in bonds. So if they get a higher yield, they're going to make more money. That's as simple as that play is. You know, when it comes to Parker Hannifin, I think it's interesting, and I like the exposure to China because China is kind of easing. So there may be kind of a tailwind there. But in this environment, until I see yields come down, you want to stick with the plays that are kind of higher yield friendly, and that would be the Aflac.
Dan?
Yeah, so Chris Verrone said something really important. He said Dan Nathan said something really important. And what he said was, very specifically, or what I said was, is that relative strength is really important, okay? And so then what do I also look for in a market like this? So we had good fundamental news in Bank America. They had good results. A lot of their peers did not. The stock has actually shown good relative strength. It's kind of cheap. It's had some good fundamental news here. And you know what's really interesting also? Guy thinks rates are going higher. Well, the 2-year did go higher. The 10-year went lower. So we have a flattening yield curve, and the stock didn't get killed today, too. So, you know, I like what he's saying about Aflac. It's already made its move. I would look for a Bank America to maybe, if we have a market that stabilizes, get back to that prior high near $50.